Thanks, Mark. Good afternoon, everyone. There's 4 areas I really want to share with you today, and hopefully we'll dispel some of those myths which are out there. Look at the opportunity as we see it in global REITs today. We'll step through the underlying property fundamentals and see how we believe it's still positioned to deliver real returns. We'll look at relative valuation, and then we'll try and bring the portfolio to life with a couple of key examples. But firstly, some context. Clearly, the last few years have been a difficult period for relative returns versus the listed real estate sector. And here we're showing you compared to global equities. You've had COVID shutdowns and a significant increase in discount rates. But as we look at the underlying fundamentals, they continue to be pretty solid. So you might think that there's some specific risk in the listed property sector leading to this degree of underperformance. But hopefully, as we'll show you today, that's not the case. And now with the sector having absorbed the significant increase in discount rates, we think it's relatively well positioned to deliver real returns. So what's the opportunity in global REITs? Why should you consider it as an allocation? Firstly, you're getting a high quality exposure to relevant real estate, and we'll explore this more on the next slide. You're doing so in a liquid and transparent structure, and that liquidity should be increasingly appreciated given the number of private funds you're seeing gate and restrict access to investors' capital. You've got the ability to provide some insulation or protection against inflation, so that growing cash flow. You're getting diversification, so 96% of the index, but importantly also the ResCap portfolio, is in offshore markets. Getting diversification by region, but also property sector, and the underlying tenants which are supporting the cash flow of this investment. It's supported by a sound balance sheet, and capital structures are actually a key competitive advantage of the listed sector today, and one area we think is misunderstood. And you've also got attractive relative valuation, not just versus global equities, but also versus the underlying direct real estate. And over time, the sector's delivered competitive returns. So what are we talking about when we say relevant real estate? It can range from necessity-oriented shopping centres, grocery-anchored, servicing the daily needs of the consumer. Resilient to e-commerce, and in the US benefiting from very low supply and some of the lowest vacancy in 15 years. Then you've got areas benefiting from longer-term secular demand trends, whether it's the need for affordable residential accommodation. In the US, where you've got material undersupply. Also in markets such as Canada. Healthcare real estate, so providing those forms of real estate servicing the needs of the ageing demographic, whether that's seniors housing, life science, medical office buildings. Data centres and cell towers, and we'll explore this more with one of our stock examples, benefiting from the ongoing digitisation of the economy, with the future demand trend of AI also additive over time. And lastly, logistics. So this is not just e-commerce, but it's about the reorganisation of supply chains, onshoring. So relevant real estate supporting those areas of the economy which are seeing good demand and growing trends. But for these sectors to deliver respectable returns, you need to have strong underlying property fundamentals. And that's simply demand, supply, and landlord pricing power. So when we look at the demand side, we've got close to record occupancy in the majority of sectors that we look at. Yes, there's pockets of weakness, whether you look at Australian office, US office, but as listed investors, we can navigate these pockets of operational weakness. Turning to the supply side. Yes, supply had tracked above the longer-term average after many years of underbuilding post-GFC, but particularly concentrated in areas such as non-coastal logistics in the US, Sunbelt multifamily. Again, we can navigate these pockets of supply. But importantly, you've got numerous areas which are already delivering new buildings significantly below the needs there are today, whether it's seniors housing in the US, delivering net inventory growth of 1.2%, single-family homes in the US, student accommodation in the United Kingdom. So plenty of areas where you've got very strong secular demand and a lack of supply. And the other point to take from this slide is you're already seeing that new supply, or the building starts, contract significantly. Construction costs, availability of construction finance, and that decline in new starts, again, is supportive for the supply outlook and landlord pricing power over time. And it's leading to healthy rent growth. So this is the outlook for our teams for the property sectors in the portfolio for 2024 financial year, so that's calendar 24. Ranging from industrial at 7%, data centres, healthcare, residential. So they're continuing to generate pretty healthy levels of cash flow from contractual increases, but importantly capturing that growth in underlying market rents given the supply and demand dynamics. And that's been the case over time. So this is showing you the core inflation, the red line, versus the NOI or net rental growth of the core property sectors in the US. And outside those recessionary periods, the sector's delivered well in advance of inflation. And it's not just about inflation. This is driven by the pricing power and the underlying supply and demand dynamics. So it's that which will really drive the cash flow growth of the real estate sector. Another factor which is a key underpinning at the moment is the rise in replacement costs. We've seen an extraordinary increase in replacement costs and the cost to develop new buildings. So this is the rolling replacement cost trend over 3 years as assessed by Zurich, the insurer in North America. And really you haven't seen this level of increase in cost for decades, the 70s and 80s. And this supports the underlying rental dynamics for landlords in a couple of ways. Firstly, if developers have to absorb this increase in cost, they need higher rents to maintain the same economic return. So that helps to underpin the rents for existing landlords. If they can't get those higher rents, development starts will decline, supply will decline, and over time, again, that underpins the pricing power for existing landlords. So this increase in replacement costs, again, is a supportive underpinning for the sector in the years ahead. It also needs to be supported by sound capital structures. And this is a key competitive advantage of the listed sector at this point in time. When you look at leverage versus history, here we're showing you US and A REITs. Our leverage is now below 30% for those index averages. And also looking at the ResCap portfolio, we're below 30% loan to value, so 28%. So low leverage for the sector. It's also important to look at the debt structures. So again, for the ResCap portfolio, predominantly long-term fixed rate or hedged debt. Well-laddered maturities and a diverse access to different debt sources. These are predominantly investment-grade exposures. They've got access to unsecured debt markets, private placements, private debt, but also banks. But importantly, they're not reliant on the banks. And coupled with low leverage, that's really putting them in a position to capitalise on some of the opportunities that are starting to arise. And there's numerous examples of this. Now this is a real flip of what we'd seen in recent years where the private equity sponsored unlisted funds acquired significant real estate because they were applying more leverage and had the lower cost of capital. That's now flipped with some of these vehicles net sellers to meet redemptions, and REITs are taking advantage of some of these transactions. So by acquiring big portfolios, whether it's logistics, self-storage, single-family homes. So again, their capital structures have put them in the position to be opportunistic. And that's different versus history and a competitive advantage at this point in the cycle. Now turning to relative valuation, clearly with the degree of relative underperformance, when we look at it versus equities, the sector's at relative lows outside of GFC and COVID periods, which were both pretty extraordinary environments. As it stands, we've got solid underlying fundamentals, good demand, supply increasingly moving in landlords' favour. So an attractive relative value setup. And that's also the case versus the underlying direct real estate. So this is the price to net asset value, where the listed sector's trading to the underlying property. And again, over time, you tend to see this close, and we do expect you'll see private markets decline. But the point here is simply that the REITs have absorbed the change in the cost of capital. They reflect the current market dynamics, and they're the relative value within the property space, and still trading at a 20% discount to these underlying net asset values. So let's move to a couple of stock examples. The first is Unite. It's a UK student accommodation business, and it's really benefiting from a number of the dynamics we've discussed here today, that being strong demand and an improving supply outlook. When you look at the demand side of UK student accommodation, you've got a growing number of 18-year-olds out to 2030, and that's really supporting the demand for purpose-built accommodation, also the demand from offshore students. And Unite's portfolio is really concentrated around those Russell Group universities, which are 24 of some of the leading universities in the UK. So you've got a good demand outlook. Supply also increasingly moving in their favour from already strong position. Supply for new purpose-built accommodation is down 60% from pre-COVID levels, and that's really feeding into the strong operating dynamics you can see. Close to full occupancy, 99%, 7% rent growth. So a portfolio with good fundamentals. They've also got a profitable development pipeline and is supported by a robust capital structure, 25% loan to value, good access to capital, and generating an attractive return outlook. 4% dividend yield, and average earnings growth over the 22 to 24 period of about 9%. So a good example of the sort of real estate we're looking for. The next is Equinix. You'll hear a lot about AI, but Equinix to us is really benefiting from the digitisation of the economy, with AI the next level potentially of demand. But Equinix is the leading enterprise co-location global data centre platform. They're in over 30 countries, 250 data centres, and it's a significant portfolio, $85 billion worth, but importantly, it's critical to their customers. So 65% of their recurring revenue is generated by customers that use their platform in all three of those regions. And it's really the attraction of the ecosystem that Equinix provides. So it's enterprise customers moving their infrastructure, IT infrastructure, into these facilities, but importantly also using it to connect to cloud environments, SaaS platforms, and other customers within these data centers. It's a network density, co-location, and low latency proposition. That's also why supply is more moderate for these sort of data centers, because they are so hard to replicate. And that's why you're seeing continued growth and pricing power for Equinix's business. The AI story, that's the next leg. It's still about the ongoing digitisation of the economy. It's an active developer. They spend about $2.5 billion a year on new data centres. And when you look at their stabilised yields of their existing portfolio, they're over 25%. So good returns on capital and largely funded by internally generated cash flow. Good balance sheet, good access to capital, and an attractive return outlook, and that's 7 to 10% compound growth. Now to the bottom line. Global REITs can give you access to really economically relevant, high-quality real estate. This is not a portfolio of redundant office buildings. You're looking at an underlying supply outlook which is increasingly in landlords' favour, and that will underpin pricing power and the ability to drive those cash flows over time. And that's what will support the real income growth and total returns of the sector. You're supported by sound capital structures, and that's a competitive advantage for the listed sector at this point. Low leverage, good access to debt and equity, and they're taking advantage of some of the opportunities that are arising. And finally, discounted relative valuations, both versus equities, underlying real estate. And over time, the sector's delivered competitive returns. So with that, thank you, and I'll hand back to Mark.